Hi, this is Anthony Lighthall. Thank you for joining me today on this podcast entitled From Dreams to Actions, where we talk about business goals, promoting positive energy, and following your dreams. On today's episode, we're going to talk about formulas and the importance of them and why you should know about formulas. So let's get into it. What are some benefits of knowing about calculating different formulas? Well, it really helps with if you have a business and to make sure that you are making profit or understanding the cash revenue or uh, your net revenue of your business and if you are making money. It's also good to just know how to run the numbers. Whenever you watch TV shows or certain things where people are negotiating right on the spot is because they know their formulas and they know their numbers and they can do quick math in regards to making a really quick deal with an investor or with a buyer or whoever. So knowing some of these formulas is going to be very beneficial for you if you have a business or just understanding the business. And again, this is not just for people who are entrepreneurs. Maybe that's not for everyone, but hey, you may sit at the round table at your job, or you may be in finance or marketing or whatever department, and just kind of understanding these numbers will be very helpful when you're trying to sell yourself or sell why you need to get certain equipment or why you should take away or no longer use certain equipment when you know some of these formulas. Okay, so let's go ahead and discuss this. I have a couple formulas here that I wanted to share with you. And the first one I wanted to talk about was net income. And what that means is it's the sum of all, um, it's the sum of income less the expenses. So the formula for this one is net income equals revenue minus expenses. And that is your net income. So I wanted to provide an example just for better understanding and context. I'm going to use an example of a painter, and I'm going to discuss, bring it full circle on what their net income is. So let's take a look at how much their materials cost. Okay, so they buy a canvas, which is what they're going to use to make their piece or paint whatever artwork they're going to paint, and then that's $25. And then they're going to purchase paintbrushes, which are $10. The paint is $15. Rags and towels just for cleanup purposes is going to be $2. And then soap to clean the brushes is going to be $1. So all in all, the total expenses are $53 to make one painting. Now, I'm not going to go into the nitty gritty of variable costs and fixed costs and things like that. I'm just really looking at the basics on what materials are needed to create this project or paint this project. And I'm not going to talk about how much their time is worth and everything like that. So continuing on, total cost is $53 for the materials for this painter. Now, when the painter creates a piece or paints a piece, they sell it for $200. So a lot of people will say, "Oh, you made $200 off that." Not so quite, because you have to take in what were the expenses in order to produce this product. So they received $200, um, but they actually made $147 because you're taking the 200 minus the 53, which is $147. So that's actually the net income that they made off of this painting that they sold for $200. And why is this formula important to know? Because just like I just said, as that example, you know, companies, businesses sell products at a certain amount, but they don't. But some people don't understand. No, you didn't just sell that. You sold it for 1,000, but you actually probably only made $550 because the expenses of making that product were probably half of that. Okay. And it also shows the difference between the income and the expenses, what you really made versus what had to be subtracted out of there. All right. And then also, this is helpful because you want to know if you're actually making money. If you sell a unit at $50, but it costs $60, you're negative $10. So why would you sell a product like that where you're not making money? The whole point of business and the whole point of scaling and efficiency is to really make money and to keep things lean, and to produce that revenue. So this is a very important, formula. It's a nice basic formula that people should know. But again, it just really shows if you're making a profit, or if you're in the positive, with the net income after producing this service or this product. Okay. So next one, let's discuss break even points. So break even, that term basically means that the total sales equal the total expenses. So you break even. That's the whole definition of that word, where you didn't make a profit and you didn't lose any money. And sometimes this really works out, for businesses starting out early on. Break even could, definitely be good for them as they continue to grow their business. Now, the formula for you to write down is break even point equals the fixed cost divided by the sales price per unit minus variable cost per unit. Okay, so let's break this down into an example here. So I want to talk about, because I mentioned fixed costs and also variable costs. So I want to kind of give more context to that, and then I'll provide an example for you. So fixed costs. These are basically expenses that you have to pay regardless of how many units you sell, or how many services you sell for your business. So example, this could be a storefront, a lease for a storefront, purchasing equipment, or paying interest on a loan, or some type of insurance, whatever terms you agreed to pay. So it's a fixed amount, so the amount is not increasing or decreasing. Now, variable cost is opposite of that. The whole term there is, it varies. It's variable cost, so it could fluctuate. It can be more this month or less the next month. So, as an example, with this could include labor, any type of commission, with the labor that's paid out to the sales team, raw materials. So basically, again, it's not consistent. And today's price was $10, but tomorrow's price may be $25 for whatever reason. It's just a variable cost. So those are the two terms: fixed cost, a cost that really stays pretty set there. It doesn't really fluctuate much. And then a variable cost, it does fluctuate with the price, just depending on the environment, or whatever the situation with what you're buying for a variable cost. Okay, so let's use an example here, just to understand a little bit more about break even. So I'm gonna talk about a cell phone store. So you sell cell phones, you have your own storefront. So the fixed cost is going to just be, $6,000 for your fixed cost. Your variable cost per unit is $25. Okay. And then your sales price per unit is $50. So that's how much you sell your cell phones for. So the formula is going to be $6,000, which is your fixed cost, and then divided by, I would put in parentheses, it's going to be $50, which is the sales price for your cell phone, minus the variable cost, which is $25. And then that equals 240 units. So what does 240 cell phones mean? It means that's how many you have to sell in order to break even, where you're not making a profit and where you're not losing a profit. You break even. So those amounts equal, as an example. Um, I also wanted to share another example too with break even and the importance of it and why it's not a bad thing. There was I have a friend that started a candle business, and they were mentioning how they went to an event, and they're early in their entrepreneurship journey. And so they mentioned how they went to a not a workshop, but like a selling fair, a vendor fair, to sell their candles. And the person called me and said, I I was like, how did it go? How much did you make and things like that. And uh, they told me that they made $300. And I was like, okay, well, that's good for selling candles for one day. And I was like, well, curiosity, how much was it to vend at to be a vendor at this location? And they said $300. So I'm like, wow, so you broke even. And the person that I was talking to, my friend, was like, yeah, but they were so hung up on they didn't make money. They didn't make a profit. And I had to explain, like, well, you didn't lose either because it was $300 investment and probably other investments too. But let's just make it simple and say, you paid $300 to go to this vendor event. And apparently it was good because people brought your product and you made, or not made, but yeah, you made $300, but it just kind of broke even because that's the same money you're going to put towards, paying the vendor fee. And I was like, also, you have to think, one, those are candles. So candles don't last forever. People are going to burn them. So if they really like your product, they're going to come back. So you already have a customer that's going to be returning, or customers, hopefully. And also, on top of that, I kind of got into how many business cards did they pass out, and talking about that. So I was like, you probably have people that didn't even purchase from you that took your card that are going to buy later on, as a gift or for Christmas or, holidays or something like that. And then also, um, they know people. So if they like your candles, they're gonna, and tell other people to shop with you. So I was like, really breaking even for you was really good. And again, like I said, this person's early in their entrepreneurship journey. And I just kind of explained that with the whole break even. That's not bad. That's actually good that happened to you during this vendor event, because you're probably going to be making more of that money in the future off of this one event that you did. You could easily do that one event, it, pay $300, but in the long run, in the next quarter, you're going to be making $700. So it just really works out, and that's the type of mindset you have to have when you're thinking about break even. Don't think about, oh, I didn't make anything. My key is always, I don't want to lose money, but as long as you broke even and what you made, you can pay for whatever that investment was. The other money is going to come in the future as well. So no need to worry about that. But I wanted to just kind of highlight that example because that was a conversation I was having with someone, and I was trying to educate, and it made a little bit more sense, after kind of talking that through. All right. So last one here, I wanted to discuss the net profit margin. So net profit margin is basically, a business's, profit that is shown as a percentage of revenue that the company keeps as a profit. So this one is going to be it's a percentage type calculation. So write this down. Net profit margin equals net income divided by revenue times 100. Okay, so let's take a look at this formula here. So you have your net income, and I talked about this in the beginning. So what's the net income formula? It's revenue minus expenses. So whatever that number is, you plug that in here as the net income, and then you divide that again by your revenue, and then you times it by 100 because it's going to be a percentage, 20%, uh, 15%, 50%, whatever. Timesing it by 100 is going to put it into a decimal form that is going to be a percentage. So, as an example, if a business has 60% profit margin, that means that the company has a profit of 60 cents for every dollar of revenue it generates. Okay, so there's probably like 40 cents that is the expenses. So for every dollar that they get in revenue, their profit margin is 60%, which is actually good. And here's the thing with let me just get into what's a good profit margin and the different percentages. If you take a look at it, 5% is a low profit margin, 10% is average, or okay. And then if you get 20% or higher, that's really good profit margin ratio. Now, the thing is, the good, the better, the best, that really depends on the industry. some grocery stores, they have really low profit margins, or some other businesses, they have a really good profit margin where their materials are so low and they sell the product so high that their profit margin is so wide, they're getting the 60%, the 70% profit margin. So that is also important to know too. This is a great formula to know because you do want to know kind of what's that profit margin, what's kind of like that buffer. And I think this example of the 60 cents for every dollar of revenue generated, that's a really good profit margin. That's a good percentage there, I would say. No matter, depending, again, just kind of depending on the industry. So again, I just wanted to share these formulas with you. There weren't too many. I'll probably do some more throughout this podcast, but I just wanted to kind of highlight on some of those. And again, it's not just for people who have businesses or entrepreneurs, but again, like I said, I'm just going to repeat that you could be sitting at the round table, could be sitting with, CFOs or CEOs at your business or at your company you work for, and just kind of knowing these numbers, even though you may not be the finance person in the room, but kind of having that understanding will be very helpful for you when you are trying to promote or sell, something that is going to be needed to benefit you and your department. Okay. So I really hope this was helpful. Thank you for watching and listening. And always remember to follow your dreams.